soundtrack to the European economy right now, at least if economists are to be believed, is a drumbeat of doom. High labour costs, ongoing worries over energy supply, weak banks and a fragmented banking market are all concerns, as are rising interest rates, the risk of sticky inflation, especially if oil and gas prices go higher, and a weak Chinese economy, as that's a major destination for European and especially German exports. Now, stock market investors are in fairness listening to a different tune. The Stoxx Europe 600 index is barely 5% below its January 2022 all-time peak, and Germany's 40-stock DAX benchmark stands within a smidgen of its highest mark ever, despite a revival of the late 1990s mantra that Germany is the sick man of Europe, at least from an economic point of view. Equally, you can take a view that neither stock market index is actually going anywhere fast right now, so this makes the timing of two European economic sentiment surveys particularly pertinent. Both are due out on Monday the 25th of September, and they are the German IFO survey and Belgium's Courbe Synthétique or synthetic curve. In August, the IFO's business climate reading slipped for the fourth time in a row to 85.7, while the expectations subsegment came in lower still at 82.6, to suggest German firms expect tougher times ahead. The Belgian Courbe fell very slightly in August to minus 14.9, as the trade reading improved, manufacturing got no worse, and the services and building sub-indices deteriorated. Note how the Courbe and its 6,000 Belgian industrialists have, in the past, been a fair guide to the Euro Stoxx 600 equity index, although that relationship seems to have broken down of late. Back home, there's a lengthy list of corporate news, although the bulk of it's coming from small and mid-cap companies, with just one FTSE 100 member due to update its shareholders. Companies which may be worthy of further research include the following, although some of these dates could yet be subject to change. HSS Haider, Personal Group and Alpha Wave IP on Monday the 25th of September, Avacta and One Spatial on the 26th, TI Fluid Systems, Saga, Finsbury Food and NCC on the 27th, PZ Cussons, AG Bar, Card Factory, Next 15, Close Brothers and Animal Care on Thursday the 28th. But the company most likely to cause a fuss in the coming week is FTSE 100 member Smiths Group. The engineering conglomerate is provisionally slated to release its full year results for the year ending July on Thursday the 28th of September, although I do stress that date is still provisional. The Smiths Medical Unit was sold off for $2.4 billion in January 2022, but Chief Executive Paul Keel has batted away calls for a more dramatic breakup. Instead, he's seeking to focus Smiths on businesses that have high barriers to entry, have a regulatory driver to them, are technology-led, asset-light, and come with strong service revenue streams to offer defensive qualities in terms of consistency of demand. On top of that comes the Smiths Excellence System, which is designed to improve returns on capital and margins over time, not least through the so-called black belts who troubleshoot any problem areas across the company. Markets have warmed to this strategy, and Smith's shares set a new all-time high early this year, although they have since lost a little altitude. In terms of business mix now, Smiths has four main divisions: John Crane, a leader in seals and couplings for industrial uses; Smiths Detection, a maker of scanners for airports and ports; Flextech, a specialist in components for moving fluids and gases; and Smiths Interconnect, a maker of specialist electronic components. Looking at the first half results back in March, John Crane is the biggest unit by sales, Interconnect the smallest. When it comes to profits, John Crane has the highest margins, followed by Flextech and Interconnect, and as a result, it's John Crane and Flextech that were the biggest earners for the first 6 months of this financial year that's just closed. In terms of what to expect, these full-year figures will be benchmarked against the raised guidance offered by Mr. Keel back in March when he targeted organic sales growth of at least 8% and moderate margin improvement on an underlying basis against last year's 16.3%. For organic revenue growth, analysts have penciled in 10.2% year-on-year growth, ranging from low double digits at Smiths Detection, John Crane, Flextech, broadly flat at Interconnect. On a stated basis, analysts are looking for total sales of around £3 billion. In terms of margins, the consensus forecast underlying operating profit forecast of $496 million implies a return on sales of 16.6%, That's 30 basis points or 0.3% higher than the previous year. That all then equates to forecasts for a stated pre-tax profit, £393 million, against £103 million last year, when £273 million of exceptional charges weighed on that headline figure. Analysts and shelves will also look to guidance for fiscal 2024 and do so in the context of Smiths Group's medium-term financial targets, which are fivefold: a 4 to 6% increase in annual organic sales, 7 to 10% annual earnings per share growth, a return on capital employed of 15 to 17%, an operating margin of 18 to 20% on an underlying basis, and 100% plus cash conversion. Now, select acquisitions may then supplement those organic figures, and going into these numbers, the consensus forecast for fiscal 2024 are stated sales growth of 3%, an operating margin of 17.3%, and a jump in stated pre-tax profit to $463 million from $393. Finally, attention will switch to the dividend. After the hiatus caused by COVID-19, Smiths has started to rebuild momentum here. Management sanctioned a 5% increase in the interim payment to 12.9 pence a share, and for the full year, analysts are looking for 42p against 2022's 39.6p a share. Note that the £742 million share buyback launched upon the medical sale was 90% complete as of March's first half results. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you next time.